Hi folks, Rick Wedell here with RFG Advisory in Birmingham, and I thought I'd reach out to you with a brief update on what's been going on in the markets. We've obviously seen a pretty strong rally over the past couple of days. We're up about 4.5% from the most recent lows. And as a reminder, those lows were really driven by a breakdown in U.S.-Chinese trade negotiations, as well as the threat of impositions of tariffs on Mexico. That drove the market into the sort of mid-2700s on the S&P 500, and we've since rallied to mid-2800s, maybe even pushing up towards 2900 on the S&P. What's been really going on is on the negative side, we have this continuing trade issue, which certainly with China doesn't appear like it's going away anytime soon. Those two sides don't appear to be very close on an agreement, and while they both appear willing to discuss options, it doesn't seem like a near-term resolution is in the cards. The president has said that he will wait until the G20 summit meetings to decide on another round of tariffs on imported goods, but this certainly seems like an issue that's going to be with us into 2020, into the next election cycle. In the meantime, on the positive side, the trade relationship with Mexico actually appears to be gaining some steam and making some progress, right? So the Mexican government has agreed to theoretically send troops up to the border to try and address some of the United States' concerns. The United States, in the meantime, continues to work with them on negotiations, and while a final agreement hasn't been reached, it certainly seems like there's a lot of pressure both in Mexico and also domestically to try and figure out a solution to this issue. The tariffs with respect to Mexico don't appear to be as politically popular as the tariffs with respect to Chinese goods. So that's a positive on that end. We also have the positive of recent developments out of the Fed, which has certainly sounded a lot more dovish with respect to interest rate policy than I think most people had feared. You had comments from Fed Chairman Powell at the beginning of the week that sort of suggested that they would keep in mind the impact of tariffs and trade policy as they set future monetary policy. And you also had, I would say, a little bit of a weaker than expected jobs report late in the week, which helped to, I think, solidify in investors' minds this notion that the next move by the Fed might actually be an easing in interest rates. Now, this is a little bit of a bad news is good news type scenario, right? We get bad news that solidifies the notion that the Fed may cut rates, and the market rallies on the rate cut, which seems a little bit counterintuitive. However, you can also think about it as, the economy is going to do what it does. The fact that the Fed is being a little bit more reactive to U.S. economic movements or a little bit of a slowing in U.S. GDP growth is an incremental positive for the market, and that's why you're getting the rally that you're seeing. So with that, as always, if you have any questions, please feel free to reach out to your advisor or reach out to me directly, and I hope you have a wonderful day. Thanks so much for tuning in.